Hello friends, I'm Vijay Bhambwani. I've been trading these markets since 1986 and through my free videos and social media content etc. I'm trying to help newbie traders accelerate their learning process and speed up the learning curve so as to be able to navigate these markets better. Now in this video, I want to touch upon a very critical aspect of trading that impacts not only your final profit and loss account, but it also touches upon a few trading bare bone realities that are often ignored in the markets. Now, first and foremost, you need to understand that trading requires two types of capital. That's right, two types of capital. Number one is, of course, the financial capital, and number two is the emotional or the psychological capital. One is incomplete without the other, and if you deplete one, the other also tends to come down. So if you lose your courage, if you lose your nerve and you get shaken up due to whatever reason, chances are you will make mistakes and close your trade at a loss. And if you run out of money, obviously you're going to be nervous as well again. Now in this video, I had touched upon exactly how much capital you need to basically have before you become a professional trader who lives purely on trading profits. But this video was recorded before SEBI increased the lot sizes, tweaked around with the margin requirements, peak margins, etc. So you will need to revise the capital that you require minimum 20 to 25% higher from the figure that I spoke about in this video. Please do take a look at this video. Now let's come to the crux of this video. The basic presumption of all scientific discovery is based on what is known as the Occam's razor, also sometimes known as the Occam's razor. Alternately, it is also known as the principle of parsimony. It says, once all variables, no matter how complex sounding, but are improbable, are removed, what will remain is the most accurate mathematical postulate, which means all other factors remaining constant, the simplest explanation is often the most accurate one. Now, a postulate is a statement that does not require validation. Like the sun comes out in the daytime, nights are dark. These are postulates. Unfortunately, financial markets, people, at least the markets by themselves are not complicated, but market participants often try to make them complicated for a variety of reasons. You would have definitely heard the super hit song from Mr. Amitabh Bachchan's movie Amar Akbar Anthony. The song is My Name is Anthony Gonzalez, where Mr. Bachchan comes out from an Easter egg and says, by the hemoglobin of the atmospheric pressure in the country. And all the girls, wow! Why? Because he said something fast, he said it in English, and it was complicated. That floors a lot of people. Now, this is jargon and technicalities at its best or worst, depending on how you want to look at it. But that's what happens in the markets, and this is something that we need to cut through, and I try to cut through in my videos. Now that we know that a postulate is a simple statement that requires no validation, like days are light, sun comes out in the daytime, nights are dark, the moon comes out in the night. This principle of simplicity is also used by our armed forces all around the world. Now, why should traders care about how warriors prepare for combat? Simple, because trading is also combat. Millions of super sharp traders with deep pockets, faster computers, more experience and better ideas are vying in the digital market, and they're trying to outdo each other in that highly competitive domain, and only the best of the best survive and thrive. Now, Dr. Alexander Elder has written in his iconic book, Trading for a Living, he said that in the days of the Roman Empire, there were gladiators who were actually slaves of the Roman state. They fought duels in public arenas and they were required to kill the loser. All that the winner ever received was not even his own freedom, but material possessions, if any, of the loser, and the wife and children of the loser became became the slaves of the victorious gladiator. That's it. Dr. Elder further wrote in his book that society has become a lot more civilized from the days of the Roman Empire, and we have basically become a whole lot less aggressive. We don't go out there with swords and shields, we don't kill people, we don't draw blood. And trading, like I said, being combat, a losing trader is not gored to death by a winning trader, but the spouse and the children of the losing trader may not be enslaved by the victor, but the suffering that the family goes through is in no way any less. So there are denial of basic comforts due to the trading loss, there is deprivation, and of course there is the hardship of having to come back up in the trading game despite the psychological pressure of losses. So don't take passive combat called trading any lightly. You may not use a sword and shield, but your mouse and keyboard are your weapons of war, and this is warfare. Now, going by Occam's razor, if we were to eliminate all mistakes, all that we basically would have distilled and left is an extremely high probability of earning trading profits. But do remember the old Wall Street saying, a trading profit is the most difficult, easy money that you will ever make. So either you're going to get it right or you're going to be lost in the wilderness of the markets. Now let's examine the military doctrine of General Karl von Clausewitz. He was born in 1780 and he left this world in 1831. He's unanimously acknowledged as the father of the doctrine of modern warfare. Remember, I compared trading to war, so I draw upon combat techniques to win in the marketplace in almost a majority of my statistical and behavioral trading techniques. In his seminal work titled On War, General Clausewitz wrote a very, very important doctrine of war, that a good general should never charge into enemy territory too fast and too hard, especially leaving his supply lines far behind. He must either be slightly behind the supply lines or at the most continue to go into battle behind enemy lines with the supply lines itself, because his soldiers will need the vital supplies of food, medicines, uniform, ammunition, and replacement of lost weapons that these supply lines will carry. An army running low on food cannot win a war on an empty stomach, nor can it win a war when its bullets are actually running out. And military history is replete with examples of how over-enthusiastic generals have rushed their troops deeply into enemy territory with trailing or missing supply lines, and they've slaughtered their men unnecessarily. So far into the video, you must be wondering, Vijay, what has that got to do with my trading? Hold on, I'm coming to that. Now, in spite of the bravado that you may hear in the public domain, caution is your best friends in the market. In the heady days of 2020 to 2022, remember, there were lockdowns, factories and offices were shut. So there was commercial activity which was either at a fraction of what it was happening earlier, or maybe even total standstill, but stocks were running up. In those days, I was a consulting editor to a company for whom I also made daily videos on financial markets. Now, to my extreme amazement, whenever I used the word caution in my video, it evoked a very strong response from trolls. And now, it's all over the place. Now, what was happening was that people did not want to hear the word caution. They were raring to go. They said, look, anybody who says buy slow or don't buy is coming between me and my millions to be, which is what happens in a game show. Jason Zweig, in his book, Your Money and Your Brain, has written that in these game shows like Kaun Banega Crorepati, etc., the game show participants were asked after the show, what did you feel when the anchor, the game show host, was actually telling you, look, you're winning X amount of money, quit now while you're still ahead, otherwise you'll drop down here. You took a chance and you dropped. But at that point in time, what were you thinking? Most of these participants say we were feeling anger. Some even said hatred towards the host because he was discouraging me from becoming a millionaire. Now, this is what most rookies do. They make mistakes on the aggression side rather than on the caution side. This is the lesson of the video, and I've got more. The point I'm making is never ever max out. Do not ever use up your entire float, bank, capital, pool, call it what you want. It's basically money that you have segregated as margin money and mark to market money for trading in the market. It's a very lousy baker who would come out and tell you, look, I can't make any more bread because I've run out of wheat flour, right? Now, capital is your freedom to trade. And if you run out of capital, you've run out of your freedom to trade at any given point in time. You may have even run out of the freedom to stay in an existing trade which you've already opened. Like I said in this video, I've already told you how much capital to trade you will require to trade. So please go through this video. Now, why did I say you will need dry powder, which means spare cash, to even stay in existing trades that you have opened? Now, this is something that real world traders understand, and non-market participants and sideline commentators do not really cover because probably they're not aware of this. Now, margins, span margins can be tweaked at any given point in time without any prior notice. Now, consider this. You could have bought a future or written an option where the MWPL or the market wide position limits. Now, don't forget, there is this video which teaches you what market wide position limit is, why it is important, and why this is probably one of the most important do it yourself indicators you can make at home. Whenever market wide position limit goes up above 60, you could have bought it when MWPL was 59 and you used up all your money there. The minute MWPL crosses 60, hey, your broker calls you, I need more money or I'm squaring up your trade. There you go, dry powder. Concentration margin goes up as and when MWPL rises by 5% every time it goes up higher than 5% above 60%. Volatility, if it rises sharply, ELM or extreme loss margins come into the picture, or if there is a special event like a budget or an election or something, you might even have extreme loss margins plus peak margins. Now, peak margins are payable within 30 minutes. If you do not make this peak margin payment within 30 minutes, your trade may not be closed, but an extreme amount of penalty is imposed upon you, which eats into your trading profit. Now, new SEBI rules also mean that your margin liberties on delta neutral strategies and or calendar spreads that you were doing in the options and futures trades, you will not enjoy discounted margins, especially on expiry days, which mean on expiry days, your requirement of margin simply goes through the roof. If you did not have dry powder, you would be kicked out of a trade because you didn't know the rules and you didn't have any extra spare cash. Then comes the ad hoc margins. Ad hoc margins are temporary margins that can be imposed by any exchange without any warning. You could get ejected out of your trade simply because you ran out of money, or you might even get away with stiff penalties, but that could simply mean that your tiny profit that you were earning could become into a loss, or your hefty profit can become into a tiny profit. But we don't really want that, all right? Now, when do you face this trauma of being kicked out of a trade because you ran out of money? Invariably, it happens when the trade is going against you, which means you are forced to book losses because you ran ahead of your supply lines like an impatient general. There are lessons to be learned from warfare, and I'm testing the waters with this video. If I receive enough positive response and viewership from this video, I will share some more trading techniques that are devised purely on combat. Now, I've heard some very aggressive advice in the public domain that defies the very logic and basis of Occam's razor and General von Clausewitz hypothesis on effective combat operations. Unachievably lofty returns promised on very tiny amounts of capital that makes for dream come true yields are advocated by many people. How? I really don't understand. It defies, like I said, mathematical logic. Now, if you were to plot this forward, the yield that these kind of trades are promising, if you plot them forward, you reinvest the profit that you made from the earlier trades, you will realize that with these kind of returns, you would be a multi-billionaire in double quick time. Look around you. Is that really happening? I don't think so. So this is nothing but kite flying. So what is the remedy here? Very simply put, keep ample dry powder. But is there a method to the madness? Yes, there is. I cannot emphasize that enough. But just how much? Now let's do some reverse engineering and let that reverse engineering guide us. The higher is your leverage factor, the higher should be your buffer amount that you're going to keep for your trade. For example, you have two trades, one in which your span margin requirement is just 3%, which means you're leveraging your capital 33.33 times. Obviously, this is a very, very high risk of gilt-edged trade, and it requires a huge amount of dry powder because you're spreading yourself very thin. So any temporary margin call shock might just throw you out of a trade unless you really have deep pockets. On the other hand, you have a trade in which your span margin is already paid to the extent of 33.33%, which means your leverage is just 3.33 times. Here, a little bit of movement against you will not result in peak margins, ELMs, and ad hoc margins, etc. So here the amount of buffer that you can keep is small. Now, remember, if there are puzzles and challenges that are posed in the market during trading warfare, there are statistical and mathematical solutions also available to you to overcome these challenges, and that is what people like me do. We devise statistical trading models and behavioral trading models that overcome these hurdles. Relax, I don't provide any paid services. I don't offer any mentorship program, training programs, etc. So this is not about money. This is just my passion in the market, and this is love's labor that I share with my online family. Now, do you want to read some more organized content or organized research material on how to do trade bet size management and capital management? If yes, let me recommend two excellent books for you. Dr. Van Tharp's Definitive Guide to Position Sizing, and the other one by excellent author Tom Beso, Successful Traders Size Their Positions. Read these two books and you will never ever go wrong in trade bet size and capital management and money management. I think these books will put you ahead of the curve, and you will basically understand a lot more about sizing your bets and how much dry powder you will ever need. Friends, before I sign out of this video, a reminder to subscribe to my YouTube channel. If you haven't already done so, click on the bell icon to receive instant alerts about fresh videos being uploaded here. In the comments segment, do let me know how my videos help you and what more I can record to help you become a better trader. And a request, these are videos that cost us time, energy, and money to make, and we are a free, lifetime free channel that doesn't charge any services or provide any commercial goods or financial goods or services. So please help us to reach out to a wider audience by sharing our videos with your friends, family, contact lists, and social media groups. I thank you for your patience in being with me in this video till we meet again in my next. This is Vijay Bhambwani signing off for now. Take care. Bye-bye.